the Group of 78. Since its origins in 1981, the Group of 78 has promoted dialogue on a progressive Canadian foreign policy based on the principles of sustainable peace through common security, social justice with equity, and survival of our planet in the face of modern human activity. Today's webinar speaks to the second of these thematic pillars. How do we achieve social justice with equity in a world in which rules are set globally while responsibilities, if exercised, are done so nationally? In particular, how can taxation levied primarily by nation states help to arrest and reverse accelerating inequality when capital is nimble, mobile, and powerful enough to bend the rules in its favor? These are urgent questions as the world economy struggles to recover from the COVID pandemic. We are fortunate today in hosting two exceptionally well-informed and connected individuals to help cut through this Gordian knot. Our first speaker, Valpy Fitzgerald, is Emeritus Professor of International Development Finance and Fellow of St. Antony's College, Oxford University. Professor Fitzgerald has acted as advisor to a number of governments, including the UK and Mexico, to international institutions, including the UN and the OECD, and civil societies agencies, including Oxfam and the Tax Justice Network. Of particular note for this webinar, Valpy is a member of the Independent Commission on the Reform of International Corporate Taxation, ICRICT. I'm not going to use that acronym, but that's what it is, founded in 2015. The Commission aims to provide authoritative technical support to global society advocacy in the campaign for a just and effective tax system. Other commissioners include economic stars such as Joe Stiglitz and Thomas Piketty, former finance ministers, scholars, activists, and tax administrators from the South. A steering group of international civil society representatives sets policy agendas and organizes outreach and mobilizes resources. But this steering group does not constrain the Commission's views, nor does it determine its public statements. Our next speaker, Toby Sanger, has been Director of Canadians for Tax Fairness since October 2018. Prior to that, he worked as the economist for the Canadian Union of Public Employees, chief economist for the Yukon government, and principal policy advisor to the Ontario Minister of Finance, among other positions. He currently is on the Council of the Global Alliance for Tax Justice and sits on the just mentioned steering group of the Independent Commission for the Reform of International Corporate Taxation. Both our distinguished speakers will be talking about reforming the international framework for corporate taxation. Additionally, Toby will talk about what Canada is doing and what it could do in this regard. After they make their presentations, we'll open the floor for discussion. Please submit your questions or comments through the Q&A tab at the bottom of your screen, and please be concise. So first of all, the floor is yours, Valpy, and thank you for joining us today.
Thank you, Roy, for your generous introduction. I must say, I've known Roy for a very long time, way back to the last century, in fact. But I'd heard before about the group of 78, but hadn't had a chance to meet them. So for me, this is a great opportunity. What I'm going to talk about today is to outline what is going on in international tax negotiations from the point of view of the South, in particular, in general, from the point of view of income distribution and poverty reduction. So, first slide, please. Got the slides up? Hello, have we got the first slide up? Here we are, right. Can you, next slide, please. Now, multinational companies, particularly the digital giants, the Googles of this world and so on, are able to avoid taxation effectively in any particular country by shifting their profits around the world to tax havens. Tax havens, I must remind you, are not just beautiful islands in the Caribbean with palm trees. They include places like Liechtenstein or the Isle of Man, or even London itself for expatriate firms and so on. So the lack of revenue undermines essential public services. The IMF estimates the annual public revenue loss worldwide is of the order of $500 billion a year. Countries, particularly developing countries, also compete for foreign investment. They also compete to retain their own firms. And they do this by reducing the corporate tax rates. The problem is that if each countries are all cutting their taxes, nobody gets any more investment than they got in the first place, and they lose revenue. So this is very much a zero-sum game, and the need to cooperate is recognized by all countries, and it's necessary in order to reform not only international taxation, but also domestic taxation. That's, in other words, if you want a progressive tax system at the national level, you do have to have international cooperation to make it work. Developing countries are especially vulnerable for a number of reasons. Firstly, because they rely on foreign investment for their modernization, and so that they are more vulnerable to large foreign firms. Secondly, because their local tax collection capacity is limited, and their local tax authorities can't really catch up with large firms in the way that the tax authorities in the US or UK or Canada can. And last but not least, they have very little leverage in the international system in order to make sure that tax policies work in their favor. However, after the global economic crisis in 2012, the G20 mandated multinational negotiations to be held at the OECD in consultation with developing countries in order to reform the international tax system. This was a huge step in the right direction, but progress has been slow. And one of the consequences of slow progress is some larger economies, including my own, the UK, have introduced their own digital levies on the Googles of this world in the forms of various tax, special sales taxes on digital sales, which in turn have caused a lot of conflict, for example, with retaliatory tariff barriers being raised by the US against the UK. Next slide, please. Well, this is graphs prepared by the IMF, and this is just to show you how extreme the race to the bottom has been. These are the average corporate income tax rate. These are the headline rates. And as you can see, they've fallen in low-income developing countries and middle-income countries and advanced economies. And all of them have fallen by about 1/2 over the last few decades. Remember that these are the headline rates. In reality, the rates that companies actually pay are much lower than this because of all the deductions. Just to take one example, in the US, the US congressional researchers have found that for the last year, that's 2018, US multinationals paid an average rate of 6% of their profits in corporate taxation. In other words, about 1/3 of the headline rate. Next slide, please. Now, this is just to indicate the size and nature of the problem. As you can see, these are estimates for 2013 of the tax losses. And the important thing here to note is that the blue column is the bulk of the tax losses are to OECD countries, as they are the richest countries. they lose the most tax money. On the other hand, if we take this tax loss as a percentage of GDP, then non-OECD countries are losing about 1.3% of GDP. Now, this may not sound much, but it's equivalent to 1/2 of the health budget in developing countries, to give you some. And it's much higher proportionally than it is for developed countries. In other words, that the bulk of the losses are from the north, but proportionally the impact is greater on the south. Next slide, please. Now, Roy mentioned the ICRICT, and I'd just like to, we've been pressing 4 precepts, as we call them, 4 central points that we've made, and we've made some headway in getting these accepted internationally. The first one is that corporation tax is a tax on dividends, that is, on wealthy people who own corporations. And we feel that raising corporation tax is the most effective way to reduce inequality worldwide. That is, in effect, taxing rich people in the north to help poor people in the south, but also within countries, it's the most effective way of taxing. Secondly, we've argued strongly and shown that a tax on pure profit, what we call economic rent, that is, profits after investment and depreciation and so on, so is not a disincentive to productive investment or employment creation. Why? Because any investment you undertake is automatically reduces your tax liability. A third point we've made is that because multinational companies earn global income and operate globally, their income, their profits are global and thus must be taxed globally, either taxed in a unitary manner by a single tax authority, but that's very unlikely in our lifetimes at least. So what can be done is to apportion it fairly between countries where the profits were actually generated. So at the moment, most of the tax income is reported in tax havens, while in fact the income has been generated in ordinary high tax administrations. So effectively, we are arguing that, that the tax base must be reapportioned to the places where it was generated. And lastly, tax havens represent a collective fiscal burden on the rest of the world. But they can be eliminated not by closing them down by force, but simply by establishing a worldwide effective minimum tax rate. That is to say, if you don't pay the tax, claim to pay tax and little tax in the tax haven, you'll be taxed the difference in your home country. And secondly, the creation of clear nexus rules, that is, rules about where where profits can actually be reported. Next slide, please. Now, what did all this mean for the South? Well, firstly, until this OECD, this G20 decision, the OECD had monopolized international tax negotiations. It had sidelined the UN and it had sidelined developing countries. But the G20 obliged the OECD to establish something called the Inclusive Framework, which includes 180 countries, and most of those, of course, are developing countries. Although we must remember that the Inclusive Framework is for consultations rather than negotiations, but it's a big step forward. Secondly, the G24, which represents the leading developing countries, proposed that the OECD allocate tax on the basis of real economic presence, that is, on the basis of the investment in your country, employment in your country, and so on, the resources used in your country. Proposed a high minimum rate to stop the race to the bottom, and full country-by-country reporting by multinationals as a single firm. This is important because it allows the tax authorities or the public in developing countries to see exactly where the profits are going, which countries and how much of their domestic. The problem, and I think Toby will come back to that, is that negotiations to date over the last few years in Paris have been a bit of a mess because they want to hold on to the old system of calculating profits as if the subsidiaries, the various subsidiaries, let's say, of IBM or Google, were all separate firms, and rather than a multinational firm. They want to regulate transfer pricing within the firms, and they also wanted to establish a very low minimum corporate tax rate. The OECD to date has proposed a formula in consequence that would only reallocate a small part of the taxing rights away from tax havens. And also they're suggesting that the taxes should be levied on the basis of the sales in each country. This again would prejudice developing countries. So in consequence, the emerging consensus which will be negotiated this summer benefits developing countries and their firms, and also maintains an extremely complicated system which these firms can gain. So next slide, please. So until January, really things did look a bit bleak. However, in February, just last month, a thaw began at last, and there were three major shifts. The first one is that the European Commission mandated the swift implementation of country-by-country reporting by multinational corporations operating in Europe. In other words, full tax transparency. The second is that the new US Treasury Secretary Yellin told the G20 finance ministers that the US administration will engage with the tax challenge of digitisation and will establish a robust global minimum tax. This is a major shift in the US position. And last but not least, the United Nations established a high-level panel on financial accountability, and they have proposed a 25% minimum tax rate worldwide and a new tax convention under UN auspices rather than the OECD. The fact that two of this high-level panel members are actually ICRICT commissioners is really a coincidence. The next stage of negotiations start this summer in Paris within the inclusive framework, so developing countries will be represented. Their sharing of taxing rights is on the agenda because even the OECD has proposed minimal level of sharing, and this is unprecedented in world history, really. It's a commitment to share taxation between developed and developing countries. And also the global minimum tax, which again will be a huge new innovation, even though it's too low, but it's still a new innovation. Both of these really are major steps, and they are the, if you like, the floor for negotiation. Next slide, please. So where does take this in the long run? Well, this, the first place it takes us, I think, which is important to note, is that, as Roy mentioned, international tax reform is central to a fairer post-COVID world. And it's relevant not only for funding requirements of global public health and infrastructure and so on, but also to reduce global inequality. So I suppose behind it all is a question, which I can't answer, but maybe people here today can. Do we think that leading nations are in fact going to return to the sort of cooperation we saw after the end of the Cold War, or are they going to continue their present mercantilist trade of each country competing with each other? Second issue, which Toby will address, is what is the role for Canada in meeting this challenge? I think looking at it from outside, Canada has a key part to play in this debate. Firstly, of course, it's a leading internationalist in the sort of grand tradition of Scandinavia, and Netherlands, and Canada, and so on, of being leading, if you like, sort of neutral powers, leading on development issues and so on. But also, of course, in Canada, you have a polity with federal tax sharing between the different member states of the federation, which, as you have seen, what we are proposing should happen, what is being negotiated at the OECD in the summer, is basically a system similar to the system in Canada. Also, Canada is a key member of the Commonwealth, which contains an awful lot of the tax havens, and also of the North American economy, which obviously is a key player in this debate. Finally, I'd like to leave you with a sort of blue sky notion to think about. That is, I've lost the, have we lost the, oh, okay. And that's this. Perhaps we could replace the entire development assistance system with effective tax cooperation. After all, we have development assistance within Canada or within the US or within the UK for poorer areas of the country who pay less tax but get more social security payments. So this would essentially be similar to the system of aid, which we already have, except that it's patronizing, not based on entitlements, but based on the political will of donors, but is essentially a fiscal transfer system as well. So possibly these negotiations will also provide a substitute for the development aid system. Thank you. Thank you very much. I think, Roy, you've got your microphone is muted. You have to turn your phone on.
Thank you, Valpy, for that very clear and compelling presentation. And thank you particularly for ending on an upbeat note where some of the clouds are dispelling and there's light ahead of us, at least so we should hope. And thank you also for presenting our listeners with a question as opposed to the listeners posing you, in addition to the listeners posing questions to you. So we'll see if anyone picks up your very interesting idea about moving away from an aid-based to a tax-based system of resource mobilization, particularly in developing countries. So without further ado, let's turn the floor over to Toby. Toby?
Yes, good afternoon, and thank you very much to Roy, Sarah, others at the Group of 78 and the participants for attending this, and especially to Valpy for presenting. This has been a really important issue that I've tried to get some more media coverage in Canada, but a lot of people aren't fascinated by international corporate tax reform, but it's an incredibly critical issue. I mean, Valpy talked about the revenues that are lost to governments around the world. The former head of the IMF basically said that the international corporate tax system is broken. And it's the largest multinational corporations in the world that benefit the most. Well, them and the tax accountants, the vast armies of tax accountants and lawyers that benefit the most from this. And it's the poorest countries in the world that lose out relatively the most, and the people in those countries that most desperately need better public services. And as Valpy put out an intriguing suggestion out there. One thing that often people have asked me is, well, why has this continued to exist, the problem of tax havens? We often have in mind these small tropical countries that function as tax havens. The reality is that these tax havens were essentially created by the financial centers. Canada played a big role in creating tax havens in the Caribbean. The UK, other countries played a big role in establishing tax havens, and a lot of them are territories of these wealthier countries. The recent tax haven leaks, the Panama Papers, Paradise Papers, revealed that people like the Queen, Margaret Thatcher, David Cameron, and we knew that Paul Martin Jr., former Prime Minister of Canada, all had some business interests in tax havens. So there was incredible resistance to dealing with these issues. There was a lot of, there was some talk about dealing with them, but very little was done until very recently. And I have to say, Valpy mentioned this as well, that it really was, well, civil society played a big role in particularly development organizations. Oxfam, Save the Children, other development organizations played a really big role in pushing this as an issue, as did the public, saying that we need to address this. So as Valpy said, if you can just put up the first slide, that would be great, Sarah. So it wasn't until the G20 until 2012, 2013 that the G20 and go to the next slide, please. That the G20 and OECD endorsed what was called a base erosion and profit shifting project to really deal with the problem of having an international corporate tax system that's basically centuries old, that relies on transfer pricing, which is easily manipulated to shift profit to subsidiaries, arm's length subsidiaries in other countries. So there was an action plan that came out in 2015. The focus was more on information exchange, transparency, and some limited reforms in different ways. There were 15 different actions. 4 of them were minimum standards, were obligatory. This was shepherded by the OECD, which was really a kind of rich countries club, but they did open it up and to other countries through something what they call the inclusive framework on some conditions. So the first action plan went for basically 5 years, but it was sort of held up on the whole issue of the digital economy, and they kind of realized that they hadn't addressed some of the deeper problems. And so what they call BEPS 2.0 started 2 years ago. And it was partly provoked by the introduction of all these unilateral measures that Valpy mentioned, including digital levies that were introduced by different countries. And so I think the large corporations and countries around the world realized that we're going to have a really balkanized international corporate tax system. So they're going to have to go forward in terms of reforms. So over 130 countries are engaged in what's called the inclusive framework. There was a deadline, a very aggressive deadline to reach some sort of consensus by the end of last year. That, of course, the pandemic intervened and that didn't happen. Now, Valpy talked about different arrangements. There was a lot of hope among the tax justice community that there would talk about some substantial reform. And you know, a lot of it was due to people like Valpy and Joe Stiglitz and others at ICRICT who also advised other countries, India and others, on pushing forward some fundamental reforms. The blueprint that the OECD released last fall, as Valpy said, it layers on limited reforms on top of an existing archaic international corporate tax system that's based on transfer pricing and arm's length principles, which are widely used to avoid taxes. So this would achieve limited and probably unworkable reforms while making the international corporate tax system far more complicated. Now, international corporate tax law can be extremely complicated. It employs a lot of high-priced help, and it's very profitable for the corporations. But there is, as Valpy mentioned, there's a role that I've pushed the Canadian government to play, because we actually, Canada and the United States and some other federal countries, have a system which ICRICT and other tax justice organizations and India and others have pushed, which would fundamentally reform it. And if you can go to the next slide, Sarah, that would be great. I'll just show you it. This is the so it could be much simpler and fairer. What we have pushed through ICRICT, and this is exactly what's done in Canada. This is just to show you how simple it can be here. Canada has used a simple 2-factor system of what is called a formulary apportionment of profits. There's basically a 1-page form, tax form, where corporations will work out what the payroll and sales is by province, and in some cases offshore offshore, that's for oil and gas in Newfoundland and Nova Scotia, add all that up, and they allocate their taxable income between those provinces on this basis. The United States has used a system like this since the 19th century. Now they use a three-factor system that includes capital in some way, but more heavily weighted towards sales. And companies that have establishments in more than one province or state simply fill out this form and allocate their taxable income according to that, and then pay tax to that jurisdiction, provincial tax to that jurisdiction on the basis of that. It's a very simple formula. So the international corporate tax system could be much fairer in this way. This is one element of reform. There's basically a few elements of fundamental reform that we'll push for in this. If you can just go to the next slide. So one element is this fair formula to allocate taxable income across jurisdiction, and especially fair to developing countries, as Valpy mentioned. Sales are more heavily weighted towards the wealthier countries, so employment and payroll are factors that are more important for developing countries. The other element is to treat multinational enterprises as unitary entities for tax purposes, so they can't shift profits to a subsidiary or an affiliate based in some other jurisdictions, which is done widely, as I'm sure you're all aware. And then establishing a minimum global corporate tax rate at a significant rate. The interesting thing, this seems like could be a pie in the sky solution, but actually a lot of countries have done this effectively. In the United States, brought this in, taxing global income at a minimum of the corporations based in the US at a minimum global corporate tax rate. Other measures, anti-base erosion and avoidance measures, are very important. And then Valpy also mentioned this. Transparency is really important. We don't even know when you go to the accounts of the financial statements of a company like Amazon or whatever. You don't know how much what their profit, what their expenses, and how much tax they pay in each jurisdiction. So country by country reporting is really important. That's be part of the whole BEPS project. But it's really important that it be transparent and that it be public in this way. And so there's a push to achieve that. So we know what companies are doing and where they're doing that and where they're making that profit. So this is really essential. There is country by country reporting brought in through that, but it isn't public. So there's much, it's important to have a global agreement, but there's also a lot that countries can do on their own in terms of introducing some of these measures. Canada, unfortunately, has been very quiet and silent on this, basically saying that we're going to wait for a global consensus to develop and not pushing for one so far. And we should be a leader and not a laggard on these issues. And hopefully we'll see some progress. It took years to get the federal government to agree, and they still haven't implemented them, to agree to introduce some measures for digital corporations, the largest corporations in the world, which are paying much lower rates of tax than domestic corporations in different ways, and they've committed to some of that through their in the recent election, but we haven't seen them. We haven't seen these measures implemented yet, and there are also a number of other measures that Canada should be introducing. So thank you very much. I really look forward to questions and the discussion.
Well, thank you, Toby, for that excellent presentation. And thank you for pointing out that Canada is also one of the founders of the system that we have of tax havens, and our banks were particularly instrumental in setting some of the first ones up a few decades ago. Okay, I invite members of our audience to submit questions, and also to heed the question that Valpy himself posed to the audience. Notably, can we think of a fairer global tax system being able to do away with the system of foreign aid allocations as it stands now? because that would generate the funds that developing countries in particular need through their own tax base. Before I turn to the floor, maybe I can take advantage of my chairmanship position here of asking one question. To what extent does the foreign trade system play into these issues through bilateral foreign investment treaties? And in Canada's case, for example, we have mining companies which are very aggressive internationally, and countries quite often vie for their investments. And part of that turns on the kind of tax deals that they can arrive at with the host country. So I just wanted to throw that out as an issue that we could think about as well.
Did you want to talk about, respond on that, Valpy, and then I can?
Yes. Yes, certainly one of the problems which Fund also identifies is that as well as double taxation, speaking explicitly about taxation, there are a huge number of international contracts and agreements with foreign investors which effectively reduce the amount of tax that they have to pay. What is worse, it's a problem inside countries in that you've got the Ministry of Industry or the Prime Minister's office going off and offering tax incentives to foreign investors, while the Treasury or somebody else is trying to stop them doing this, right? What I'd say here is that, of course, if you had a military tax system or the sort of tax system we're talking about, this wouldn't really be very effective because although, let us say, a mining company would pay less tax in Zambia, it would have to pay the tax in its home country, right? Because they wouldn't be able to deduct that from their tax liability, right? So the company would end up paying the same tax anyway, right? So that the incentive for the companies of asking for tax breaks would be enormously reduced because they wouldn't get any money net. Right? Perhaps I can explain this in very simple terms. For example, if I, here in the UK, go to France or to Canada to lecture and I'm paid money to do so, I can choose to either have the tax reported to my tax authorities in the UK or pay tax in Canada on the spot. But of course, if I pay tax in Canada on my lecturing fees, when I get back to England, I have to put that on my tax return. And because the tax rate is higher in the UK than in Canada, I have to pay the difference. In consequence, I am completely, I can't game the system. Right? And so I think by implementing the minimum tax rules and country by country reporting that we're talking about and the allocation rules, the incentive to ask for these breaks and the incentive for countries to give these tax will be reduced enormously.
Great. If I can just add to that, Canada has and other countries have got dozens of. You talked about trade agreements, Roy, but Canada also has dozens of tax treaties with a whole lot of other countries. One of them I was just talking to a reporter this morning about was one with Barbados, which was the sort of granddaddy of these tax treaties, and it allows Canadian corporations with affiliates with taxable income in Barbados to bring back income in Canada, basically tax-free after they've paid tax in Barbados. Barbados has got a preferential regime where they charge only 2.5% corporate tax rate, which then becomes lower the higher the profit. It goes down to 1% for higher profit, and this was something that was brought in 1980. This particular tax deal. And then it was extended. We have also got what are called tax information exchange agreements. the benefits of these were extended and basically without a vote in Parliament, to extend it to all these tax information exchange agreements, which were signed willy-nilly with a whole lot of tax havens. So Canada has gone ahead and signed all these treaties in this way. You mentioned mining companies, Roy. I'm always somewhat astounded that Canada is supposedly home to 50% of the publicly listed mining companies around the world. And that's because we've got some particular provisions and also weak corporate transparency rules. So don't know who owns certain companies in these ways. You can, in some provinces or territories, you could have instead of having a real person, you could have a numbered company that was a director. So there was very little transparency over who owned what. I used to live in the Yukon. And more recently, I was surprised. I was looking at some big companies that paid their executives. They were on the top executive list. They're mining companies based in Canada that essentially had no operations in Canada. I noticed that there was the same office address to it, and it was a small clapboard lawyer's office that I knew in Whitehorse, population 25,000, right? So Canada itself has functioned as a bit of a tax haven for these for a lot of these corporations, and those have gone hand in hand with a variety of different trade agreements. I don't pretend to be an expert to know all the ins and outs of all of these and investment agreements, but particularly some of the free trade agreements. I mean, those have had provisions that have really benefited foreign companies, Chapter 11 and other types of provisions, which have been very beneficial. In fact, they've been. I made the argument that these so-called free trade agreements have been more protectionist in a way because they're all about protecting capital in this way. So they've been the real protectionists in this way.
Okay,
I don't know if that helps answer the question, but no, we've been very complicit in doing this through our own agreements in this way.
Okay, thank you both for those detailed answers. We have a few questions in the queue now, starting with one I'm not quite sure I understand. What are the other international taxes collected? I'm not sure if this is a reference to individual as opposed to corporate taxes. Can either of our speakers take a guess?
It's sort of interesting. I don't know what maybe Claire can expand on this, who asked this question. A lot of this discussion also sort of developed, and Valpy suggested this as well, over the whole sustainable development goals. And there was a discussion before the crises about having carbon taxes or financial transactions taxes or other types of taxes like that could then be used to support sustainable development goals. But they're not taxes. Not much has been achieved through this, and these are taxes. What we're still talking about now is about individual countries collecting those taxes, not about but having international agreements over how about the.
Toby, you're frozen.
Well, Toby, perhaps I can carry on a bit.
Yeah, if you would.
Talk about international corporate tax reform, but there's no such thing as any international taxes. All taxes are collected locally by individual jurisdiction. So the question is cooperating in order that they can do their job effectively. That's the point that we're trying to make. There is no real suggestion that the United Nations should run a supranational tax system in just the same way that the WTO doesn't actually, for example, run the world trade system, trade with each other. It just establishes the rules and also acts as an arbiter, if you like. It doesn't establish rules. It is a forum where the rules are hammered out by the individual country members, and then it acts as a forum for arbitration when they disagree with each other. So even if you were to have a world tax authority, it would look much more like the WTO. In other words, it would be a forum where the countries would get together and agree on the rules and how to distribute the tax base in the way we explained. And it would also act as a arbitration locus, so that when countries disagreed, they could have somewhere to go and have their disagreement done. There's no proposal for an international tax as such. Right? And the same would apply even if we had carbon taxes. Those would be administered by individual countries. Right? But again, would need a forum to decide agree on the rules about it. And then obviously you need some sort of arbitration agreement so that if countries were in disagreement about something, let's say China said they were being unfairly dealt with by the rules estimating the carbon content of Chinese exports, let's say, then you would obviously need some sort of forum and some sort of arbitration mechanism for stopping what happens at the moment, which is when, for example, the UK and France and so on put on a Google tax, then the US replied with taxes on whiskey and brandy and champagne and so on and so forth, would obviously cause chaos.
Okay, I'm going to bunch the next two questions because they seem to flow into each other. Claire Adamson asks, additionally, wouldn't rich countries still escape corporate tax, e.g. 6%, while poor countries would pay 25%, if that's what's suggested? And then Richard Harmston asks, to what degree are corporations lobbying or applying pressure to governments to prevent a fair tax regime, and how effective is this effort? What countermeasures can be taken by civil society and others? Toby, you're back with us now. We missed you.
Yes, sorry. Somehow I got cut off and it took a while to get the internet going again. I'm on a different computer.
Do either of you want to have a go at these two questions?
Well, I can start. I'm sure David can get to finishing. So when we say that US corporations are only paying 6%, what we're suggesting is that all countries have a minimum 25% rate, right? So that this would effectively raise the rate paid by US corporations. Now, whether they paid that to the developing country or that 25% was accrued to the US would depend on the allocation rules that we've been discussing, right? And our position is that the the 25%, would be allocated between countries depending on the level of real economic activity that took place in their country. So that in consequence, the Barbados and so on get a very small share of this income because very little real activity takes place. Yukon the same would get very little out of it because there's only a nothing much is happening. But of course, where the activity is taking place in Zambia or South Africa or so on, would get the bulk of that in. So that's what we're arguing. On lobbying, it's interesting. Obviously, multinationals do lobby, but they don't generally directly lobby places like the OECD or the UN. What they do is two more subtle means of lobbying. One, the most obvious one, is lobbying the Minister of Finance in their own country and get him or her to shift their view, right? So that's the most obvious one. But the other one, which I think is very interesting, or maybe just me as an academic, is lobbying particularly through the big accountancy firms in trying to establish a sort of what a sensible grown-up view is on this, right? So they to try and say the technical answer is this, right? This is how it must be. And that what you in the civil society are saying is basically fine and good and morally superior, but you just don't understand this subject. So that there's a use of professional expertise as a means of dominating the conversation. One of the things we've been trying to do in the ICRICT is to mobilize people who, either because they have Nobel Prizes or because they're ministers of finance or because they're tax collectors and so on, cannot be said to be, just goodwill merchants with sandals and so on. They really know what they're talking about. And I think that perhaps the most difficult bit of lobbying to fight is that lobbying which, in a sense, expresses itself as scientific. That's the worst, most difficult.
Mm-hmm.
Valpy's absolutely right on that. I mean, there's increased interest in the role of the accounting firms. And they like to portray themselves, and they're often portrayed as these independent experts. But so often they're massive promoters of tax avoidance or tax dodging, tax evasion schemes. And that's been the case here in Canada too. I mean, KPMG played a major role in what was called the Isle of Man scheme. They've never been prosecuted for or charged for that. And the same thing around the world. And exactly, they play a big role at these international negotiations. So, but they profit enormously from these from tax avoidance measures, and they make a lot of money out of the large corporations that benefit and individuals who benefit from this. So, and as Valpy says, that's been one of the most challenging things because they've got this aura of authority and professionalism as well. So.
Okay, that exchange actually anticipates the next question, which was posed by Manfred Bienefeld. More and more companies are going private because reporting requirements are less onerous. And within that, they set up many interlocking companies, thanks to the KPMGs of this world, I suppose, to shift, hide profits and costs. And these trends are further exacerbated by additional complexities introduced by these activities of hedge funds, fragmenting income streams in many ways. So here comes the question. Does effective tax reform have to be preceded or accompanied by a significant degree of financial re-regulation or simplification?
Am I supposed to answer this, or is Toby going to answer?
We can both.
Whoever wants to go first.
Okay, so one point that I would say also is that yes, more companies have gone private, and I guess need to be very, very conscious of that. I mean, one of the reasons why more corporations have gone private is because there's so much money out there as well, and they've been able to. There's large profits. There have been large share buybacks by these companies, and the hedge funds and private equity have played a big role. So these big players in international finance have been able to buy up companies. I mean, pension funds actually also play a role, right? I mean, Canada's public federal pension plan for the CPP owns Rivera, which is the largest long-term care and a whole lot of other areas too. So, but the large amounts of corporate profit, I think, have contributed to increased privatization of companies. So fewer are publicly listed. We know less about them. But
Valpy?
Just a couple of points to develop that argument slightly. And private companies are subject to corporation tax in exactly the same way as public ones. So although their information may not be available to the general public in the way that a quoted company is, they're still available to the tax authorities. And we've also campaigning that even private corporations would have to report their profits publicly, country by country. The problem of hedge funds and so on and so forth, again, in principle, just as tax, the most regulated companies in the world actually are banks. There's only one type of company in the world that has to report its balances nightly to the authorities, and that's a bank, right? Because they're, from the beginning of time, it's been recognized that they require special supervision. So again, in principle, I don't think that's the problem. what is true is that the increasing importance of private wealth operating outside the corporate structure is multinational corporations is a major problem, and it's that's why the Commission is starting in its next stage of work to move on from corporate tax to looking at wealth tax issues worldwide as well. Just last but not least, on the pension funds issue, it's very often people say, but you're taxing dividends, and the main beneficiaries of dividends are pension funds, and the impression is that we're talking about poor widows somewhere in the Yukon or somewhere, relying on their sort of public service pension, a sort of retired nurse or something, and that we're being against her, right? That's the image given. But you must remember that the concentration of wealth in pension funds is even greater than the concentration of income generally. In other words, that the pension fund assets, the income from that asset, is even more concentrated towards the upper reaches of retired civil servants than the wages are, right? I don't know if I'm explaining myself correctly. So, in a sense, a tax, even if it falls ultimately on pension funds, is a progressive income tax, right?
Okay, can I move to the next question? Are you through, Valpy? I think we have enough time to cover the last couple of questions, if I may proceed to them. Barry Mitchell asks, what is the incentive for countries and companies to accept changes of the sort that you've been talking about to the current situation? What leverage or pressure can be used on reluctant players? And Connor Doherty asks, how do we address the lack of transparency within tax havens when secrecy in their banking sector drives demand for their services? I think we've touched on this during the discussion, but who would like to go first?
Well, I'll have a go. The incentives on countries to participate, I think, is a sort of what the international relations people call a two-level game. I mean, at the highest level, if for the purpose of argument, the US and the European Union make a move in a particular direction, then it's very likely that a large number of other countries will follow in their wake. I mean, that's what we see, parallel of trade negotiations. Basically, that tends to happen. Possibly, you have to include China in that mix. So if you could get the EU, US, and China to agree on some principles of international tax reform, I think the rest of the world would probably come into line. The other factor is it has to be civil society pressure, it's democratic pressure. That is to say, the reform we've been able to achieve in the European Union has come through pressure on the European Parliament. And that pressure on the European Parliament has come from journalists, from voters, from civil society organizations, and so on. So it's at those two levels, I think, we need the pressure. On secrecy, I think it's very interesting about tax havens. When we're talking about tax havens, not only, as I said, Cayman Islands, but Delaware and so on. The interesting thing is if you want to put your money in a tax haven, you want it to be a secret, but you also want it to be safe, right? Because you can send your money to Moscow and it'll be in secret. It won't be safe, right? So what you really need is an effective rule of law. So you want your money in a place that doesn't tell anybody where money is, but it's safe. So the rule of law, right? And the rule of law is precisely achieved in countries which are in some sense being overlooked or supervised by a larger legal system, which is why these British colonies or semi-colonies are so popular, because they're supervised by the British legal system. You know your property is safe, but at the same time it's a secret. And remember, it's a secret not only from the tax authorities, but also a secret from the police. It's also a secret from your creditors, so they can't chase you. It's a secret from your minority shareholders. And above all, it's a secret from your wife. I'm not making this up. If you read the brochures that they send out, it's all there. It's sometimes even in black and white. Protect your assets from from your wife, if she divorces you. So what I'm getting at is that the secrecy depends on a rule of law, and that rule of law is ultimately supervised by the US from New York or from London and so on and so forth. So I think the measures to cope with them is firstly, as I said, the minimum tax rate, which means that even if you have your money in Bermuda, you're still going to be taxed on it in the UK when you bring it back or send it there. And one possibility is a retention tax, which means that any transactions you make with Bermuda will be taxed at 25%. Now, if you can show that you already paid the tax on that, then you can have it back. Meanwhile, you have to pay 10%. And secondly, of course, would be to pressure these administrations to reveal to the tax authorities exactly who is holding that is beneficial ownership regulations, which have already been passed but are quite different to implement. We do have those. So beneficial ownership data automatically exchanged with tax authorities is the basis how it will work.
Thank you, Valpy. Last words, Toby?
I can't really. Valpy explained that terrifically, and I can't add much more. Except I just really do want to reemphasize the importance of civil society in pushing for change. Right? It has been good to see great to see some progress in this. But it's really been brought about by pressure from civil society on this, and the amounts out there are extraordinary. There's the IMF itself estimated it could be 600 billion. That was for a few years ago. That's lost every year. The Parliamentary Budget Office here in Canada estimated up to 25 billion. Lost through profit shifting by corporations. They're really significant amounts, and even more important for developing countries, as Valpy laid out at the beginning of this. So it really is one of these instances in which it is the largest corporations, which are becoming even more concentrated around the world, that have benefited the most. And this is also connected to the growth of billionaires, who often are the shareholders, owners of these large corporations. And it's the least fortunate and the poor who are being hurt the most from the existing system.
Okay, we're going to have to bring this to a close. We're over time slightly. No one seems to have picked up Valpy's question to the audience, but when you consider that the amount of revenue losses suffered by developing countries probably greatly exceeds the amount of aid they get in ODA, there is some logic to moving towards a system where developing countries are much more based on domestic resource mobilization rather than the charity of richer countries. So hopefully Oxfam's involvement in the steering group would be able to close that loop, because they're looking at a fairer and more just world, but taking that back to their own sort of backyard, they could also be advocates for greater domestic resource mobilization through a tax system that works for developing countries. Anyway, that's my crack at Valpy's question. Before I close, I'd like to remind our audience that our next webinar on April the 15th will in some ways touch on some of the things we've been talking about. The subject is potentials and pitfalls of climate responsible investment. And we have a couple of speakers from the responsible investment sector. And this is an area of great debate, as some of you might know. So please stay tuned. The details will be up on our website. April the 15th at 1 p.m. in the afternoon is the time of that particular webinar. So I'd like to thank both Valpy and Toby for their candid and very enriched responses to the questions that our audience put forward, and for helping us think our way through these complex matters. And I'd like to thank our audience for participating and for those who submitted questions to have done so. Okay, so thank you, everyone. Thank you, Toby and Valpy, and goodbye.
Thank you, and looking forward to seeing you in real life at some point.
Thank you, Roy. Occasion. Thanks. Goodbye then.